The next session is the keynote address. We look forward to many insights in this session. We also wish to thank Sage Publications, publishers of Dr. Acharya's book on Quest for Restoring Financial Stability in India, for being supportive of this conference. This session will be moderated by Vidhu Shekhar. Vidhu Shekhar is the country head of CFA Institute in India. Mr. Shekhar is a seasoned finance professional with over 30 years of industry experience. He was previously vice president at the NSE. He has also contributed to the development of Indian financial markets through his participation in the work of various committees set up by regulators. Over to you, Vidhu.
Thank you, Lakshmi. It's our great privilege and honor to have Dr. Viral Acharya as the keynote speaker for this day one of the second India Fixed Income Summit 2020, being organized by the Chennai chapter of CFA Society India. Let me take a moment to introduce Dr. Acharya to you. In fact, as they say, as it's usual to say, he needs no introduction, especially to this audience, because I'm sure that when he was deputy governor, you were hanging on to every word that he uttered and poring over every speech that he made. So, it's quite unnecessary for me to read out his biography, but I will still do so as it is the duty assigned to me. So Dr. Viral Acharya is the CV Star Professor of Economics in the Department of Finance at New York University Stern School of Business, NYU Stern, and an academic advisor to the Federal Reserve Banks of New York and Philadelphia. He was a deputy governor at the Reserve Bank of India during 2017 to 2019. He was the director of the National Stock Exchange of India NYU conference for several years and has been part of several committees and subcommittees on financial regulations and securities market. Viral completed his Bachelor of Technology from the Indian Institute of Technology, Mumbai, and has a PhD in finance from NIU Stern. His speeches while at the RBI, as Lakshmi said, were recently released in the form of a book titled Quest for Restoring Financial Stability in India. He has authored or co-authored several other books in the past, including Guaranteed to Fail, Fannie Mae, Freddie Mac, and the Debacle of Mortgage Finance in 2011. So, in a way, Dr. Acharya's book is just a compilation of the speeches that he made in his 2.5 years as deputy governor. But here is the book, and many of you are going to get a copy of this if you registered early for the conference. And we're thankful to our sponsors for doing that, and maybe we can procure a few more copies for those who haven't been able to get it. Now, it is a compilation of speeches, yes, but it is more than that, because Dr. Acharya takes a look at the whole landscape of central banking, banks, governance, markets, the macro picture, and so on and so forth. So, the book is organized into 6 separate sections, parts, which look at different aspects of this world. Now, specifically, we requested Professor Acharya to focus his remarks on the market side. In the preface of his book, he talks about 2 things on his checklist that he wanted to do before he came in as the deputy governor. One was to contribute to the fixing of the problems that banks have. So let me read out from the preface that I have in front of me. First was to fix the health of the banking sector, especially that of public sector banks, with reforms such as consideration for a change of ownership, recapitalization, prompt corrective action for undercapitalized banks with repeated track records of poor underwriting standards, etc. Second was to develop financial markets to improve the efficiency of capital allocation, reduce the dependence of the system on bank credit, and allowing for market-based mechanisms to reward and punish the borrowers and the financial sector for their outcomes. Now, this second bullet point in his preface is what I requested Professor Acharya to focus on, because he's talking to an audience of investment professionals mainly analysts, fund managers, investment advisors. And we are now taking on a higher responsibility than we used to have during the days when credit intermediation was mainly done through the banking sector. More and more of it is now happening through the markets. And it's important for us as investment professionals to understand the realities that we are facing, not just on a day-to-day basis, but also when you have discontinuities and sudden changes. And we need to understand how India is special, and in the context of the environment in which we operate in India. So over to you, Dr. Acharya. I'll keep watching for questions, and after your remarks, we'll come back to the Q&A conversation.
Great. Thank you so much, Vidu and Lakshmi, for giving me the opportunity to speak, and for the very kind and generous introduction. As it turns out, this is literally the last talk I'm giving on the book. I've decided to take a break after this for at least a month, and hopefully no one is interested in the book thereafter, just to refuel my batteries. It's also an interesting coincidence that my last speech when I was at the Reserve Bank of India were also connected to development of viable capital markets, and why government bonds in India have a very significant crowding out effect on growth in the rest of the economy. These speeches were released just as I was wrapping up my term. In fact, the crowding out speech was released just a day before I left the Reserve Bank of India. As Vidu said, what I want to try and do is first give a macro sense of the bond markets as I see it, and then touch upon a few very important specifics, because Vidu alerted me that this is a highly specialized and qualified audience, which is not just interested in the micro to macro connections, but also in specific details. The book has a very extensive preface chapter, which is called Fiscal Dominance, Theory of Everything in India. And the main point I'm trying to make there, and it's not a new point, maybe I've focused on it more than others have. In fact, Governor Patel is actually one of the primary exponents of this idea in his research prior to joining the Reserve Bank of India. So what is fiscal dominance? Fiscal dominance in macroeconomics is a state of the economy in which government debt and deficits are so large that the central bank is distracted from its price stability or inflation objectives, and is primarily focused on lowering rates or pumping in a ton of liquidity, either by purchasing government bonds in the primary market or the secondary market, because it wants to help the government roll over its debt at cheap costs. In the very extreme version in the macroeconomics models, it is to avoid a sovereign default. But in practice, it doesn't have to be a default. It may just be a sovereign downgrade, because if your costs of borrowing are rising very quickly, very often the sovereigns, when adverse growth shocks occur, or when debt is very large relative to your taxation capacity, they would have to issue additional debt in order to roll over their past debt. But of course, this leads to a ratcheting up scenario if growth doesn't pick up very, very quickly. And the central bank says, listen, I can't really focus on inflation right now. I have to save the sovereign balance sheet. In some cases, this may be a justified action, which is that a sovereign downgrade or a sovereign default may actually be quite catastrophic for the economy. But there could also be times in which the central bank simply comes under pressure, and that is what fiscal dominance is about, which is that the fiscal side of things, the fiscal authority dominates the financial sector regulatory policy. Usually, this doesn't play out very well. Argentina is a case in point over, given its, 9 defaults over the past 100 years. Turkey at present is, I think, heading in this direction since I don't know how many years, at least a decade, and is subject to constant upheaval in the markets. And essentially, if you observe the central banks of these countries, their policies look a bit strange. And that is what happens under fiscal dominance, which is that when the government debts are rising very, very sharply, these central banks actually ease interest rates, even though inflation is actually rising, because they say we just have to get over this temporary cliff over which my sovereign is about to fall off. But usually the sovereign debt and deficits have grown because they are being too extravagant in their expenditures. They are not cutting back on the inefficient expenditures in good time. They are unable to liberalize or divest from government-owned enterprises whose debt burden itself comes back to haunt the sovereign, etc. And so in spite of the temporary accommodation of the central bank, these debts and deficits keep mounting. And because they keep mounting, the money supply growth in the economy keeps rising. Inflation expectations become unanchored. Markets do not expect that if inflation keeps running away, the central bank will actually, let me use the word spine, to actually raise interest rates in time and prevent this cascading inflation from now unraveling what the central bank was trying to do. See, the central bank is trying to soften the sovereign's borrowing problems. It's trying to prevent the sovereign from a downgrade or a default. But if inflation expectations and the realized inflation itself become unanchored from the price stability that the central bank was supposed to maintain, the central bank loses commitment, it loses credibility, it loses reputation, you can call it whatever you want. And actually now the long end of the yield curve becomes completely difficult for the central bank to control. Now the central bank controls the short end rate, it's pumping in a lot of liquidity. So of course the short end rate collapses. But you find that the term premium doesn't come down, and in fact, the term premium may start rising because the long end inflation expectations have become unanchored. Now, why am I spending so much time explaining this? Because this is the cycle that emerging markets that have not been able to maintain their inflation credibility have gone through. They've gone through a cycle of accommodation of the governments and their bond markets in the short run, with easy accommodative monetary policy, which doesn't show signs of addressing inflation when the inflation impulses have begun to mount. Sometimes temporarily they allow the situation to remain calm, but the sovereign actually continues to borrow even more during this period. And so if either there is a growth shock, or if inflation expectations become unanchored, or because the money supply, which has been growing with central banks' accommodative policy, starts actually creating further demand pressures in the economy, you end up basically with a very severe inflation ratcheting, as they call it. The second point, in case of the two countries I mentioned, Argentina and Turkey, usually these have led to onslaught in the foreign exchange markets. Why? Because foreigners who have put their money into the country, they know that once inflation expectations become unanchored, the real value of their dollar savings, which are inside this country, are getting eroded. So they would like to exit from their carry trades. These carry trades are most typically in the high yielding fixed income instruments. They could even be in the blue chip equities, because blue chip equities are very, very liquid to get out of. That's precisely the reason why FII ownership is generally very high in the blue chips, because they know you can sell a large stock of equity at once and vote with your feet on the external sector when you need to leave. And so what the picture that arises from this is that once the central bank, instead of trying to act as a checks and balances on the fiscal deficit, sort of goes in the bed with the government in actually raking up further fiscal deficits through its accommodative monetary policy, you basically get these tail risk of inflation rising very rapidly and creating not just a domestic yield curve problem, but also an external sector problem. Now, what has all this got to do with development of markets? Okay, and let me make three connections here that are quite important in my view. First, when I was at the Reserve Bank of India, I co-chaired a report on the development of viable capital markets in emerging market countries. This was with Li Bo, who was at that time at People's Bank of China. And it was a report that the Bank for International Settlements asked us to write, which is what are the conditions that are prerequisites for development of viable capital markets in emerging market countries. And when we looked at the literature, the primary conclusion that we reached that the most important thing a country can do in order to create a viable capital market is actually stable macroeconomic conditions. If growth is stable, if inflation is stable, if government bond yield curve is not too volatile and not at very elevated levels, these are actually the most important factors that are conducive to the development of capital markets such as, say, corporate bonds. And why is this? Because very often when you take positions in corporate bonds, there is duration risk built into it, which is that you are taking on sensitivity to interest rates, especially at the medium term or the long term where these bonds are issued. If you have a fixed coupon bond and interest rates rise, you are exposed to duration linked losses on these bonds because interest rates rose and you have locked in a lower interest rate on these bonds for the maturity of these bonds. So very often the hedging of a corporate bond position happens using the government bond yield curve. You trade different securities on the government bond markets in order to shed this duration risk onto others who want to bet in the government bond markets. Now, if the government bond markets are very volatile, they are showing signs of ratcheting away of inflation. So the long end is actually very volatile and unstable because of these inflation surprises. If there is a lack of commitment and credibility on part of the central bank that it can actually maintain the long end, the term premium, not so much the long end, but the term premium from not rising a lot, then you can use these instruments to hedge. But if the prices in the government bond markets are essentially determined not by a stable expectations of inflation and term premium, but they are just determined by the supply of government paper. How much is the government going to supply every quarter into the market? And if that becomes a first and foremost determinant of the government yield curve, it becomes very hard to actually hedge the duration risk because the government yield curve is being driven by technical factors, which is that the supply is actually too large relative to the savings of the economy. So first, the reason why capital markets don't develop in countries with unstable macroeconomic fundamentals is because these countries' fundamentals don't support a stable yield curve and inflation and term premium. And as a result of that, any hedging activity on corporate bonds with the government bond yield curve becomes very, very difficult. So that's point number one. Point number two is that there is a very simple crowding out effect, which is that when the government debt and deficits are very large relative to the net savings rate of the economy. Take India, for example. Government has been dissaving on a consolidated basis, not in an official deficit sense, but in a true or objective deficit sense, at least 8 to 10% of GDP over the last few years. And the numbers may rise in the COVID year. Now, this is far in excess of the net savings rate of the households. Indian corporates are also net dissavers. They also net are raising money in the markets relative to the savings that they have. What this means is that if you just took a closed Indian economy perspective, the savers, which are the households, are basically supplying their savings to the government bond market and say to the corporate financing. The corporate financing may be in the form of debt, it may be in the form of equity, but let's say it is in the form of debt for simplicity. Now, of course, if the government dissaving is larger than the savings of the households, the money has to come from somewhere else. Where is the government getting the money from? In the aggregate, this money is coming into India from outside. The external capital markets, the dollar financing, the euro financing, the yen financing through the external sector is entering the Indian debt and equity markets. What I'm trying to say is that India, given its present macroeconomic conditions of how high government debt and deficits are relative to the net savings of the Indian households, is basically financed on the margin from outside. We are very, very heavily reliant on external sector capital flows. And therefore, it should be no surprise that in March, when the COVID outbreak happened, and when there was heightened uncertainty and all risk trades were off, so everyone was moving out of emerging markets, our stock market crashed very, very dramatically. And the moment Federal Reserve and the other large systemic central banks decided that we will offer our balance sheets to the global capital markets, including to their own respective governments, everything has calmed down. And in fact, from what I read, this year may be a year of bumper foreign capital flows into India. Now, immediately, you can see that the corporate bond issuances in India are now presently very, very calm. What I mean by that is immediately corporates are able to issue at very low rates. The central bank in India has, of course, adopted accommodative policies of its own, similar to the accommodative policies in developed economy central banks. So domestic liquidity is very high because the central bank is actually buying huge quantities of government paper, and foreign liquidity entering the Indian economy is high, either because the central bank is buying the dollars and then creating rupee liquidity, or because the foreign capital is directly coming into FPI flows into India. Whichever way, it's relaxing the liquidity or the crowding out constraints for the Indian corporates. So unsurprisingly, right now, the scenario looks very, very benign. And the problem with this is that what I show in the crowding out speech, which is the last speech in the book, is that if you look at large stretches of time and divide, say, over the last 20 years, you divide the years into two sets, one where FPI flows into India have been large, and a second set in which FPI flows in India have been relatively low. What you find is that corporates and the corporate borrowing, their yields at which corporates are borrowing, they have no connection to the government bond yield curve when FPI flows are very large into India. Okay, so that's a very benign situation for the Indian corporate. However, in years when FPI flows are not that strong, and this happens quite a bit because it depends on external conditions, it depends on foreign interest rates, it depends on policies of the foreign central banks in terms of their liquidity injection. It depends upon whether idiosyncratic events such as a Turkey problem or an Argentina problem or an Italy problem are happening in the global capital markets and creating an aversion from risk which emerging markets such as India offer in terms of risk-return trade-off. In all these scenarios, the corporate bonds very often in India come to a screeching halt, because what happens is that the corporates become reliant on rolling over their debts that they have taken on. But the quantum of liquidity that is available in the Indian economy shrinks because the FPIs are pulling out their funds. Now, when this quantum shrinks, it is not that the government borrowing in India follows some counter-cyclical pattern that the government of India will say, oh, because FPI flows are not there, let me reduce my borrowing. The casual expression I like to use is that no, the government expenditure and its needs are a bottomless pit. They only are going in one direction, at least as far as the recent trajectory is concerned. So if government borrowings continue to rise and suddenly a pool of liquidity available in the domestic economy vanishes, it's the corporates which will have to bear the brunt of the higher borrowing costs. Now, what I'm trying to say is that the fiscal dominance is at work in India in a very, very perverse way, which is that the Indian corporates are first crowded out. Because they are crowded out, they are very, very heavily reliant as a whole. Clearly, not every Indian corporate can borrow in the foreign capital markets. But as a whole, the corporate sector is very heavily reliant on foreign financing. When foreign financing goes through its ups and downs, the corporate cycle in India goes through its ups and downs. And it can come to a screeching halt when the FPIs are not actually providing funds into India. Now, there are subtle versions of this that I sketch out in the crowding out chapter in the book. My favorite episode as a researcher for understanding how the Indian corporate market behaves is actually the the NBFC situation that we ran into in 2018. Now there it was a combination of easy money flows in 2017 plus the post-demonetization liquidity glut in the formal financial system. Both of these made it very easy for NBFCs and even some corporates to raise money, especially at the very short end. Now, why were they switching to the short end? One, because the government was issuing a lot of paper at the long end. So there's a technical crowding out that's happening in that segment. So they said, why should I pay this term premium? It looks out of sync with the term premium that you should pay purely based on risk. The term premium in India, very often you will see a comment in media that the term premium is very high. The central bank needs to bring down this term premium. The truth is, you can't do much about it. It just reflects the fact that the government is saving too much relative to what the net savings in the Indian economy are. And when the corporate flows are not that strong from the outside world, the term premium will actually remain elevated. Now, of course, inflation could be high, and that could also be a reason why the term premium is elevated. So the corporates rolled down the yield curve in order to cheapen their costs of borrowing. Because they say, why should I pay this excess term premium? Let me borrow at the short-term rate that's pretty much in control of the central bank, and I'll take an interest rate bet. Maybe I'll just roll it over in the next quarter, 90 days or less than 360 days. Let me just keep rolling over these debts. Now, what is the problem with this rollover risk strategy? The problem is that if inflation expectations continue to rise, or if central bank has to raise rates, or if the supply of government paper increases further, or if the FPIs pull out, you're going to experience an increase in your cost of borrowing. And then you can have accidents if corporates have not, NBFCs and corporates issuing short-term debt have not managed their liquidity or asset liability management very, very well. So in case of the NBFCs, what we found actually during our research when I was at the Reserve Bank of India was that several housing finance companies had switched their debt composition. They used to issue non-convertible debentures, which were longer than 1 year of maturity typically. They had switched more than 50% of that into very, very short-term commercial paper during 2017 and first half of 2018. Then when inflation rose, dollar liquidity shortened because reduced because Fed was normalizing its balance sheet. We had an oil price shock in 2018. If you recall, from April to October, oil went to as high as $80 to $85 per barrel. And all of these created close to a perfect storm with RBI spending close to $50 billion of reserves to stabilize the currency, etc. And the corporates were bleeding on the right. And that's because they had shortened their maturity. And everyone essentially blames the NBFCs for this. It is my assessment that it is a systemic problem. What is the systemic problem? The systemic problem is that we have too much government debt and deficit, especially at longer maturities in the financing of the government. That creates a technical component to the term premium in India. It's the fact that there is too much supply of paper chasing too little savings. It creates a problem that the central bank gets fiscally dominated and has to start providing liquidity and sometimes even keep rates low. So the short end comes down, but the long end doesn't move. As a result of this skewed term premium, everyone starts rolling down the yield curve and starts borrowing at the short end. Now, why are they borrowing at the short end? Because they don't want to pay the high premium. Why is there a high premium? Because the government debt and deficit are very large. So unless this debt and deficit come down, you don't get any relenting on the long end of the yield curve. In fact, I find it super interesting that regardless of what the central bank attempts to do at the short end, of course, it controls the interest rate. It can flood the market with liquidity. Right now, the rates are even below the reverse repo rate. The long end is not showing these kinds of softening at all. It remains extremely stable between 5.75 to 6.25%. And that's basically showing that if you can borrow short, you can avail of the interest rates, but there is nothing happening for you at the long end. Now, of course, borrowing short creates an asset liability maturity problem. It creates a rollover risk problem. And that is something that the country will have to continuously contend with unless and until the fiscal deficit and the borrowing programs come down. The third point and the last point I want to make in this vein, and then I have one extra point to make on the plumbing of the corporate bond markets. So the third point is that how is this large supply of government debt accommodated? Either the central bank buys a part of it. That has been the trend over the last 2 years. Prior to that, a lot of it was ending up primarily on public sector bank balance sheets, either through explicit pressures or implicit pressures. Dr. Reddy, who has written a masterful foreword in my book, in fact says that, it was not at all, throughout the history of RBI, it has not been that uncommon either for the government or the central bank as the debt manager to basically get public sector banks and public sector owned financial firms to help support the government bond auctions. It's known to everyone that this is how our markets are made to sometimes clear in the auctions. Now, if you look at it even right now, even though the statutory liquidity requirements are now below 20%, the effective holdings of government bonds by Indian banks as a whole is 30% of deposits. It's in excess of 30% of deposits. Now, what is the problem with this kind of a nexus or a tight linkage between the banking sector and the government is that when you have an inflation surprise or an interest rate shock or the government bond yield curve starts moving up, for the reasons that I described earlier, they could be domestic, they could be external. What you find is that not only does the government's cost of borrowing rise, it imposes a huge collateral damage on a very important part of the economy, which is the banking sector. The banking sector starts making losses on its treasury positions. Some of these have to be marked to market. They may rush to the finance ministry and lean on the central bank, either directly or indirectly, to soften the mark-to-market requirements. But it will be seen in the stock prices of these banks. The markets know that these positions are large, that the bonds are losing value, and they will start eroding in their value. And the downward loop or the spiral or the doom loop, as it's called in the academic literature, starts taking hold, which is that the more the yield curve steepens, the more are the losses that the banks are making. And because their economic capital is getting wiped out, the less is their ability to actually participate in the future bond auctions. And this doom loop carries over to the corporate bond market because the government bond yield curve is, of course, the reference point over which all the other curves are determined, including the credit spread. In fact, there is research by Dr. Sajid Chinoy of JP Morgan, and we show this research, including in my last speech, the crowding out speech in the book, that in times when the interest rates are actually rising or when interest rates are coming down, there is not much pass through to the corporate bonds. The corporate bonds are just moving up and down with how the long end of the government bond yield curve is moving. And that itself is not that affected by the interest rate policy of the central bank. It's moving actually mostly with the supply of the government paper. So these are very important fiscal macro considerations that, in my view, are constantly affecting the corporate bond market. Whether there is enough space to issue corporate bond markets, what is the spread at which corporate bond markets are being tapped by our companies, how they are dependent on the external sector, why the corporate maturities roll down to the short ends in certain periods of excess liquidity, and why that creates a rollover risk in the corporate bond space whenever the interest rates are rising. If you ask me, even though the interest rates are below the reverse repo rate right now, prudent corporates should actually not issue very short-term debt because the interest rates most likely have only an upward way to go from here, or at minimum stay flat. So if you just load up right now at the short end and invest it in your long-term projects, you are taking on tremendous asset liability mismatch. And I don't know if corporates are necessarily hedging the duration risk of these assets, most likely not. And so that would be one sort of practical implication of this, which is to stabilize your asset liability mismatch right now, because interest rates and inflation are suggesting that they have more likely an upward trajectory from here on rather than a further downward trajectory. Now, the last point I want to make is that a second point crucial point we stressed in the viable capital markets report with the Bank for International Settlements is that insolvency and bankruptcy code, how you resolve corporate distress, is a first order determinant of the development of corporate bond markets. Because if the bankruptcy codes are not functioning, they are not respecting the transfer of control rules which are laid out in the letter of the law, if they are not respecting the priority of the creditors in the waterfall of how liquidation or restructuring proceeds will be passed down to different creditors, if the courts get routinely stymied by either industry lobbies or political considerations on how a particular case or how a particular sector should actually be dealt with, this is all very negative for corporate bond market investors, both domestic and especially foreign investors who may not have much access to these kinds of lobbying opportunities. So I think on this front, we have done overall better over the last 5 years. I think the Insolvency and Bankruptcy Code of 2016, I consider it as one of the most important structural reforms of the Indian economy. In terms of its progress, I would say it has been fits and starts. Some parts of it have done very, very well. I think the resolution of small cases seems to be happening much faster than it used to earlier. Recoveries are there for the banks and the corporate bondholders, and that's a good sign. Nevertheless, in some cases, especially large ones, as we know, there have been frictions and interventions. Right now, of course, the code is stayed for fresh cases. I'm not a big fan of these kinds of blanket suspensions of resolution of corporate distress, because the bankruptcy code is sort of like a shadow under which any private restructuring of contracts has to happen. And in India, if the corporate bond market is to become large, given the minimum stipulated requirements for issuing corporate bonds, then I think we do need some mechanisms for banks and the corporate bondholders to actually come together, sign intercreditor agreements. It can't just be one regulator-driven activity. It can't just be a central bank-driven activity. I think insurance companies, pension funds, non-bank finance companies, banks, all have to be able to come and sit together for intercreditor agreements in order for bankruptcies to proceed smoothly, in order for workouts or restructuring outside of bankruptcy as prepackaged bankruptcies to work smoothly. Right now, we have a very banking focus on corporate stress resolution. But I think if corporate bonds are to be important in India, this focus has to be pan-regulator and pan-creditor focus rather than a very banking sector focus. Of course, I touch upon in the book that there may be fiscal dominance issues here as well. The government doesn't want to recognize losses on public sector banks, and therefore it may actually prefer to arrange the rules of the game sometimes in a manner that favors the banking system rather than the broader system as a whole. If that remains the case, then it will be another difficulty in getting a thriving corporate bond market to go on. So let me stop there. I wanted to offer this macro to micro view on why the government bond market is actually a very, very important determinant of how corporate bond market in India behaves. Why the corporates in India generally have faced that even when they have been able to tap markets, it is either associated with an external sector risk or it's associated with inflation risk in the domestic economy. And third, that if the corporate bond markets are to develop further, and we want stable flows into this market, I think it is in the interest of corporate bond investors to push for even more predictable and stable performance from the insolvency and bankruptcy code, rather than it being subject to a lot of judiciary uncertainty, stays, suspensions, uncertainty about when courts are going to reopen, etc., etc. Because my sense is that, I don't have the exact numbers with me, but my sense is that while equity flows into India have been very robust over the last 9 months, both in FDI as well as FPI equity, I don't think that is the case for the Indian debt markets. Indian debt markets, both the GSEC and the corporate bonds, have not actually had very stable flows. And I think it requires some introspection as to why, in times of extremely benign global market conditions, Indian debt markets are not attracting the level of flows that the Indian equity markets are. It's possible that some of the things I've touched upon may have something to do with it. Let me stop there, Vidhu, and take some questions, if that's okay. If you want me to touch upon something else, either now or in Q&A, please let me know.
Sure. Thanks, Viral. That was very useful, comprehensive, lots of different things. And we have a few questions coming in. I just want to quickly ask you, you'd said that you wouldn't advise corporates to borrow at the short end right now just because the money is available. We see a lot of money coming into mutual funds. What will be your advice to mutual fund managers who are tempted to invest in some of these papers? And we've seen cases in the past where investors have faced unexpected problems investing in credit funds.
Yes. So in the book, actually in the preface chapter, I have 2 pages which are devoted to explaining the Nbfc crisis of 2018. It's very complex, but this theme of the debt liquid funds comes up there. I think what's happening is that interest rates are very low, partly because of the monetary policy and the extremely easy liquidity conditions, justified or unjustified. I'm not getting into that. But what has happened is basically, as you know, when these rates are so low, you basically have negative real yields on fixed income instruments in the economy, especially at the short end. Inflation is at 1 year horizon higher than what you are earning on 1 year paper. So, of course, investors are searching for yield. They are wanting yield at different horizons. So those who want to park their money at the long end are probably going into equities. Some of them are realizing that foreign flows are also coming into equity left, right, and center, probably creating potentially frothy valuations. So some investors are cashing out because they've been waiting to cash out over the last 6 to 9 months after the correction. So some of them are cashing out. But importantly, just this situation is not entirely unlike the post-demon situation, in my view, which is that the cause for why the deposit rates have fallen, why the real rates are not very high, are different right now. Post-demon liquidity was caused by formalization of the informal money. The liquidity right now is explicitly engineered by the central bank and the foreign inflows that are coming into the economy. Whatever it be, the real rates on fixed income instruments are low, and immediately at these times you see that money starts going out of deposits into these liquid debt funds. It may even be a broader allocation into these debt liquid funds. Now, why are the debt liquid funds attractive? Because everyone thinks that, like the money market funds in the US, they give you a very safe deposit-like claim on relatively short-term paper. And the hope is that because they are not investing in government bonds, they are investing in corporates, they can earn a little bit of extra premium, and this becomes your extra yield for the savers on this paper. Now, of course, the question to ask is, what is this extra premium for? It must be because there's some credit risk on the corporate. It must be because these bonds are possibly illiquid. The funds can't just get out of these positions at a quick overnight notice if they want. And possibly there is, even at the short end, maybe there could be a small amount of interest rate risk that is built in, even if the central bank might have given some forward guidance on the future path of relatively near-term, short-term interest rates. So the reason why I think this is not a good scenario is because I think the money that goes into debt liquid funds is treated by the savers like money. It's their deposit-like claims. They want that this money be available at full par value, or maybe a little bit interest on top of that. If they fear that a downgrade is likely to happen, some of the money that's going to the corporates is not going to actually deliver the par value, full value, then you will again start seeing the kind of problems we saw with ILFS and Housing Finance Company problems in August and September of 2018. It is no different than the money market funds problem of 2008 in the United States when Lehman Brothers collapsed, because expectation of the savers into these liquid debt funds is that this is like deposit, it is safe money, I'm just doing this to get a little bit of extra interest. The moment we have one significant downgrade or a default from in the borrowing space in these markets, we are likely to see the kind of vulnerability that we saw. Your question was more about what the mutual fund should do. In my view, they should invest only in extremely pristine quality paper, and they should manage their own asset liability mismatch, which is that if they have to sell a part of their portfolio at loss in the markets, it should not create a run kind of a dynamic on their savers. Now, how can they provide confidence against this run? One, if they have more liquid buffers, they won't have to necessarily sell the paper at fire sale or costly liquidation prices. They can hang on to it. Second, sometimes these funds are run out of families. So there are some larger sponsoring either non-bank financial firms or sometimes even corporate firms. And then these families can actually set aside capital, earmark capital that can stabilize these funds in case of such stress. And that will become a credit enhancement of the mutual fund, so that the savers won't necessarily run on this at the first sign of trouble. In fact, in the US, what is very interesting is that when Lehman Brothers collapsed, the run happened on those money market funds which did not have another equity balance, equity from another balance sheet backing it. So some funds were in a group of families, and some money market funds were standalone money market funds. And it were the standalone money market funds that actually experienced the runs. Those that had some equity from another balance sheet backing it actually did not experience very violent runs. So I would say both solvency as well as liquidity management by these mutual funds can stabilize the risk of potential downgrades and fire sale liquidations that they might have to engage in. On those,
yeah, very interesting. Actually, we keep doing occasional roundtables, with portfolio managers. This is a very good topic for us to dig deeper into the practices and see what you need to do, and maybe even talk to regulators. Now, I have a couple of people asking me about why fiscal dominance doesn't have the same effects in, say, US and Japan. I think you have covered it in your book. You talk about fiscal dominance, and in emerging economies, it really creates instability, but doesn't seem to be the case in a country like US, where they're borrowing seemingly without limit.
Yes. See, there are many reasons. I would say the two foremost are, which are of course interrelated, is that these countries have extremely deep debt markets. They are hard currencies. They are safe haven currencies. The world invests their savings in store of value, as in dollars or yen, or the Eurozone bonds, which are implicitly backed by the stronger Eurozone country balance sheets. Why is that the case? They have better institutions. They have greater predictability in the functioning of their markets. They have better rule of law, and these. There's a little bit of a self-fulfilling prophecy into these currencies, which is that once they become very large, they start getting used as collateral for all global transactions. International trade contracts are settled in dollars, regardless of which country the corporation is based in. Dollar and treasuries are used as collateral in all exchanges, derivatives markets, interbank contracts, etc., etc. Now, once you have that, that no government is going to be able to walk away from honoring these claims without completely disrupting their own domestic economy. And so the expectation is that these countries are not going to do what happens in Argentina, which is that why are we using our taxes to pay foreigners who have bought our bonds when we can use this money to pay the pensions and the salaries domestically? Because the collateral damage that will happen to the US economy from a disruption in the repo market in the US securities is so large that at the end of the day, they will say, listen, we have to keep this tap going. We have to continue with this privilege that we have of a safe haven currency. We don't have that status because our institutions for markets are not as strong, because our inflation is not as benign as in these countries, because we have just embarked in the last 5 years on building an inflation credibility and commitment at the central bank. We don't yet have the luxury of completely opening up our external sector and letting the money come in and have the expectation that even if risks of the macroeconomy in India increase, foreign investors should not pull their money out. We know what happened during the taper tantrum. We had a 25 to 30% correction of the Indian currency and various markets because we got caught up along with the famous five, as they say, when the Federal Reserve just signaled that we are going to start the taper at some point in future. An actual normalization had also not happened. What happened in 2018? Once the actual normalization and raising of interest rates happened, it unfortunately coincided with an external sector shock and burgeoning debt and deficit problems in India. Again, we had pulling out of funds, and we spent over $50 billion of our reserves to prevent excessive volatility of the currency. So we don't have the macroeconomic stability or the institutional credibility and commitment to be in a situation where people lend their money to us, and even if the economy wobbles, they say, no, the long-term security of this money is still very, very high. So that's first and foremost. And therefore, I always push for institutional credibility and commitment building for India. I've always been pushing for macroeconomic stability, structural stability of the Indian economy, rather than finding silver bullets that will get us from this quarter to the next quarter or this year to the next year, etc. So that's one point. The second reason why we can't have the situation that United States, Japan, etc. have, I think, has to do with the taxable base of the country. The tax base of countries in the developed world is very, very high. They have formalized their economies close to fully. It's not that easy to evade taxes. They do. Companies are doing jurisdictional arbitrage across the world. Nevertheless, the tax base is high. But even there, you can see that one reason why the US debt and deficit numbers, by the way, it's not the case that people are not concerned about it. There is a lot of discussions happening every day in the United States on the sustainability of the US fiscal situation. And part of the reason there is because the US tax buoyancy has not increased much in recent years. There is a lot of this international jurisdictional arbitrage, done by tech companies and all other large companies. As a result of which, both the wealthy as well as the US corporates are not paying as much tax as you think they would be paying. And of course, the government debt and deficit numbers are ramping up with every successive stimulus, and the debt is just getting rolled over to higher and higher numbers over time. So I would say that, one should not assume that these countries will never have a debt sustainability or rollover problem. Every country can start looking like an emerging market, in my view. It depends on how they run their economy structurally. But right now, I think there are significant differences. And so one common refrain is that, if they are choosing real negative rates, why can't we? I think the difference is that our inflation is already very high. They are below target in their inflation levels. They are trying to get inflation up to their target levels, which are lower than our target levels. Their target level is at 2%, and inflation is not rising to that level. We are already above our target. We are actually above our band of that target. And so we can't, given all these other conditions I mentioned about macroeconomic stability, external sector vulnerability, I don't think we can just take the view that, we can just forget this problem for the time being. We'll worry about it when it comes. If you adopt that kind of strategy, we would be going down the path of Argentina and Turkey. And I don't think these are the countries we want to emulate as far as our macroeconomic and external sector outcomes are concerned. Vidhu is frozen on my screen, Lakshmi. I don't know if it's the same for you.
It's frozen here as well. Now,
Okay, so I think
no, now I can't hear Dr. Acharya. Now it's back, I think. Now you're okay.
Yeah, I'm back, but I think Vidhu is frozen.
Yeah, Vidhu is frozen, yeah.
Yeah. So I don't know if you are able to see the questions and you want to curate from that, because I don't think
I can't see the questions.
Okay. I can't see them either. So
I'll just send them a message.
Yes. Yeah, I think Vidhu has dropped out, so he's probably trying to reconnect. I think we'll just give him a few minutes.
Sure.
Maybe I'll just mention one thing, which is that there's a recent report that has just come out by Raghuram Rajan and Mario Draghi. It's on the sustainability of corporate debt coming out of COVID. They're talking about long-term debt solvency issues affecting corporates all over the world, including in developed markets where a lot of easy money has been thrown at corporations. Several sectors have likely lost revenues that will not come back, especially in services, energy sector, and a few others affected by COVID as well. You might want to look at this report to see the kind of suggestions they have, both for corporates as well as for policies that can prevent the corporate debt imbalances from building up further. Because as I said, at least I'm concerned that low rates, easy liquidity tends to get the corporates in India to borrow at the lower end of the yield curve. But then it comes to a screeching halt once the inflation and rates start rising. And I'm concerned that that is the only reasonable scenario in the near future in India.
Viral, there is a question.
Hello.
Yeah, I can see the question.
Yeah, can you hear me, Lakshmi?
Yeah, I can now, Vidhu. I can hear you.
I'm sorry, my laptop froze, so I just logged in from my mobile.
Okay.
So can we keep doing it like this?
Yeah, why not?
Yeah, okay. Right. So anyway, we have a few minutes left. And sorry, I just sort of broke the chain. See, Viral, you were talking about banks' management of their interest rate risk. And in your book, you have a detailed policy prescription, many things that you suggest banks that should do while they are managing the interest rate risk on their books. What has been your experience of actually banks doing some of these things? Is it different between one bank and the other? Do you find boards behaving in a different way and so on?
Yeah, I see. Overall, our experience was that the duration risk seemed more unmanaged in the public sector banks. That was our experience. Maybe partly because over the last 5 years, their holdings of GSECs have been very, very large. They've not had enough capital to do much lending. And as I was saying, both due to explicit and moral suasion pressures, public sector banks are often showing up at the auctions more than perhaps they would like to on their own. And what happens is you get into a very bad kind of agreement where, once they know that the central bank is willing to constantly keep giving forbearance and mark-to-market relief, what is the incentive to manage these risks? You want to basically buy these bonds, hoping that interest rates come down. In fact, the position of the banks will be used as pressure to not raise rates as well, or keep liquidity conditions easy. And I think they are in fact used. That was my experience, either in direct conversations with bankers or indirectly through, conversations that they may be having with the government. Then it gets relayed to the central bank. It becomes a one-way bet. And I think this is costly because it favors essentially the government bond markets more through regulatory dispensations than other kinds of risks in the Indian economy. See, already capital requirements are very low on these bonds other than mark-to-market. If on top of that you don't even do mark-to-market when the losses arise, then what is the cost of, there is no risk management incentive left in the system to actually take on these risks. It reduces discipline on the government because the market prices of the bonds are based on a risk-taking view entirely rather than actually managing the interest rate risk. And the interest rate risk essentially then gets dumped onto the central bank to manage. And of course, the central bank having to keep easy liquidity conditions and interest rates lower than what they need to be is ultimately going to show up in inflation. And that inflation is a tax that the savers of the economy are paying. What is happening right now with high inflation? On the one hand, of course, high inflation means that everyone's real value of money is eroding. Now, if you are a borrower, this is not as much of a problem because you are also benefiting from the low rates. But if you are a saver of the economy, high inflation is just a net cost. It's a tax on you. It's a transfer from the savers of the economy to the borrowers of the economy. So to come back to your original question of whether there are differences in practices, I think what I was trying to say was that the differences in practices are primarily between public sector banks and private banks, in my view. If we want a thriving bond market, if we want an interest rate hedging market, if we want the derivatives markets to take off, I think we will have to get public sector banks to manage their duration risk on an active basis. Even one or two large banks actually willing to manage their huge stock of government bonds in a duration sense and shed some of this risk through the complementary markets, the hedging markets, the interest rate derivative market, could give tremendous fillip to these markets. It will bring in capital, both domestically as well as foreign capital of players who are willing to provide the other side on this interest rate risk. And it could lead to a more vibrant interest rate swaps, caps, floors, and other kinds of derivatives markets in India.
Hello, can you hear me? I'm back. My laptop is back now. So, one of there was this inevitable question that I was waiting for, and that's on MMT, right? Everybody wants to know what is your view on MMT, and we actually had a session sometime back on this. So, what's your view on MMT discussions that are going on right now, as well as its applicability to a country like India?
See, it's a very appealing framework to a lot of people, to governments, to policymakers, to bond market holders, etc. Because it basically says that you can get away with murder and not ever have to pay any price for it, which is that, you can just see, if it was so easy to grow by just printing money and funding the governments and their deficits, and for the governments to take this money and create jobs in the economy, I think we won't be working so hard, I think, to create growth and create value. We just have to elect the right leaders. They can be given loads of money and they will take care of the people. I think most people who study MMT don't realize that is what it comes down to. It says, appoint your king, give the king unlimited rights to give and distribute money to you, create jobs for you, and everything will be hunky-dory. I think if it was so easy, I don't think the countries that tried to socialize, centralize, or run as communist countries would have found it so hard to generate sustainable growth. Yeah, they were in charge of everything. They were creating jobs. They had central banks that were serving the interests of the governments. But it doesn't work, unfortunately, for a variety of reasons that were mentioned. So if you now go into and look at the theoretical foundations or conceptual underpinning of the MMT, it never says what and when are you supposed to react and how when the government debts are no longer sustainable in the markets. It assumes inflation is not a problem. So when you push them, they say, yeah, of course, if inflation rises, you have to close the taps and close the valves. Okay, how are you going to do it? How do you build credibility and commitment that you will close on the inflation valve in good time? Where will you get the signals for closing the inflation tap in good time. Normally, the inflation expectations are either backed out from surveys and most importantly from the bond markets. Now, if you completely destroy the bond market, because the central bank balance sheet is essentially the unlimited repository of the government bonds, how are these signals going to get generated? So in my view, MMT is a very appealing view for policymakers who want to abandon decades of principled thinking that has gone into economics for inflation targeting, for controls on government debt and deficit programs, for a limited size of the government that is focused on public goods rather than trying to provide too much that can actually be better provided by the private sector of the economy. For a lot of these people, it's a convenient policy tool on which a lot of questions are not being asked. But the moment you dig a little deeper into MMT, you realize that it doesn't tell you what the exit strategy is. When the problems arise, where are the signals going to come from? Who is going to react to these signals? How? And if that is not to become an Argentina or Turkey kind of scenario, how do you build credibility ahead of time that the markets won't think you are a banana republic? And I think MMT doesn't answer this simple, commonsensical questions that a simple look at the history of countries in the world who have pursued MMT kind of policies have experienced. It doesn't entertain them. It says that United States will always be United States in its current form, regardless of what policies it pursues. But that can't be. Great countries in the past have had declines if they have not followed the right policies. Yeah. And so it's a framework that I don't know what to make of. I like to call it voodoo economics, but somehow because that's the policy theme that's going around, everyone has jumped onto the bandwagon without asking it any tough questions. So
it's a sign of the times that something like this is becoming so popular in discussions. So anyway, we will leave it at that. Well, we are getting to the close, so I just wanted to ask you about your, whether you feel optimistic. How optimistic do you feel? Because your whole book is about what should we be doing, as individuals, as firms, as regulators, thought leaders, etc. And we've had, the pendulum oscillating. We went through a period of optimism when we did a few things, seemed to be working. Then we regressed. Before we close, I just wanted to touch on that aspect. Where do you think we will be, say, in 5 years' time on all these issues that we are trying to fix?
I try not to have feelings about the economy. I'm an economist, I have an analytical mindset. So I like to look at data. I try to make sense of it. And my sense is that India has to focus on structural aspects of its economy. Some reforms are underway on the real economy side, on labor, and some reforms have been in the process of getting consensus in case of farm bills, however contentious. Clearly, we need more of this, hopefully on the land right reforms side. What I push for in the book very heavily is reforms on the fiscal and the financial sector side. By revealed preference, I do think fiscal dominance is an issue in India, and that the only way out is to actually get the fiscal to a better position in the medium term. We have to take our targets seriously, monitor it objectively, not just meet our targets through off-balance sheet accounting. And we need massive divestment and liberalization initiative in a large number of non-strategic sectors, including the financial sector, in my view. Of course, a lot needs to be done on banks. Right now, a lot of issues related to moratoria and debt restructuring have been kicked down the road because banks are not being asked to mark the losses very aggressively. But we have a legacy loans problem, and now there is going to be further stress on top of that. So I think we do need to fix the banks. We do need to look at the governance, accountability, and productivity of the public sector banks. Is the current ownership structure the right one? Can they be made to be at a distance from the government? Can we divest the stakes at some point? Can we actually reprivatize some of the better ones fully? I think these are important questions that we need to ask. So I don't have a sort of optimistic or pessimistic feeling necessarily. My take is very simple. India has grown fast when it has embraced reforms, when it embraced liberalization post 90s, when it embraced divestments during 98 to 2003. My assessment of governments since the global financial crisis, since 2008-09, is that governments have resorted since then to financial wizardry. They have resorted to quick fixes and band-aids. They have kicked the can down the road on India's banking sector, first using them as a stimulus vehicle, then not recognizing the loans in time, before having fixed the first problem, again using them for stimulus when some other elections are coming up, and then again having kicked the can down the road, partly during COVID for maybe more justifiable reasons than in other kinds of years. And we just don't seem to be taking these problems very seriously, in my view. There is a lack of consensus and political will, both in the government, bureaucracy, as well as in the regulatory space, that we need to fix these problems for the next 10, 20 years, so that, like China, we can actually grow at a stable 7, 8, 9% for a long stretch of time, not as a one-off year, but for a long stretch of time. I think we can't grow well sustainably without undertaking structural reforms on the real economy, fiscal, and the financial sector. So what happens in 5 years is, I think, going to be based on how we do on this front. I don't think that magically somehow, because we are hardworking people, we are ambitious people, we have set very lofty targets. Just that is not enough, in my view. That's just hope. But hope is not a strategy for running an economy, in my view. I think it has to be very structurally grounded overall. So, let me just end with a joke. I would also like to be Roger Federer, but when I'm on the tennis court, I just have to do my drills and get my game structurally right. And then I can improve a little bit. If I get the right drills for several months in a row, maybe I'll do better in the next tournaments. If I keep continuing with it, then I'll get better and better. It's very aspiring to be Roger Federer, and that's a good goal to have. It's good to be inspired by him. But to think that I can just be Roger Federer without hard work is, I think, is just setting yourself up for failure. So,
good. I think that's a good note to end on. We are 10 minutes past time, and I think all of us have a responsibility. We know that when the will and political leadership, etc., is there, what needs to be done. So if the conditions become right, we know what path to take. And I think it is a responsibility for all of us to talk about these things, try and understand these things better, and try and practice as much of it as possible as professionals, as leaders in our own small ways. So I'm hoping that will happen. Thank you so much, Viral. I think this conversation has been very, very useful. I will very strongly recommend that you go and read Viral's book. I found it very interesting. I know.
He's gone off again.
Yeah, I think we've lost Vidhu. No, that's okay. I have to just move to another meeting very soon. So thank you everyone for being such a patient audience, even though we've taken a little bit of extra time. I'm very delighted to have ended my book e-tour with a talk for Vidhu at
Vidhu's back.
Second India
Fixed
Income Summit of 2020.
Yes, you're back.
I wish you all happy holidays and a new year, and I hope things continue to keep improving on COVID front as they have in India over the last 3 months. Take care, be safe.
Thanks. Thank you, Viral. Thank you, Viral. I was thanking you while my laptop froze again. Thanks so much. Back to you.